everybody that looks at markets and then what's priced in, they don't understand how you price things, right? Like, what do you mean it's not priced in? There's a price that's out in the market that's supposed to be correct, and there's the price that I believe to be true. So you mentioned a couple of interesting things. You said term doesn't seem right. So let me try to translate, and then you can tell me where I'm wrong. When you say that, you mean like relative to history, the price of like term premium should be X, and right now it's X minus that, and we need to get back up to that long-term average. Am I right in the first assertion?
Yeah. The basic
simple observation like that,
right? The basic point. Just think about it very simply. Like, there is cash has no risk. Lending your money out has risk, even against a person, an entity that will for sure pay you back, right? There's interest rate risk, and so in order to do that, and you're parting with your money for some period of time, right? And so you'd expect to get more in the future than you get today if you part with your money and you lend it to somebody. Yeah. That at some level that's a very simple observation, yeah. But what that means is, okay, so how does that work? The yield that you're getting on cash necessarily is lower than the yield that you should get on instruments, because you'd expect to get a higher yield to incentivize you to lend out your cash for that term. Now, of course, you have to think about that in the context of what is the expected path of cash relative to those long interest rates. And so it's not just like literally the yield curve defines what that looks like. But if you start to think about like, okay, well, we expect maybe a very modest easing of monetary policy, so the expected forward yield of cash is still pretty elevated, frankly. And then what you look at is those bond yields that are trading at 100 basis points below cash. You start to say to yourself, well, it's what am I getting for giving my money for 10 years? And the answer is not much. In fact, maybe even negative, a negative return still at this point.
Okay, and so let me no. I just
want to qualify.
I just want to make sure I understand. So you have that. So you have that's one thing, right? That's the differential, and now we also have the added element of there's a bunch of supply coming in from the Treasury and other places, right? So like, is this? There's one thing to say that it's undervalued. Equity markets have been overvalued for a decade. The other thing is, when is it going to be a catalyst in order for that to turn around?
Right. And that really, what it comes down to is there's value, which really, if you think about term premium, that's a value concept. And then there's, supply and demand at any one moment. And so you have to think about who are the buyers and who are the sellers at that any one moment, and also start to think about not just their incremental buying and selling, but their balance sheets. And so if you're a long only, if you're a pension fund or an endowment or stuff like that, and you went hog wild for those 350 yields that were being offered earlier in this year, like you've, not only have you probably gotten your fill on how many bonds you're holding, but also you're a little burned by that, by having lost, 10 to 15% on that trade. And so, you're starting to okay, so then who are the folks who are going to come in and buy the bonds? Like, I know that sounds like such a simple point, but it's like, where are the people that buy the bonds? Like, if you look back in the last 10 years, who bought the bonds? The Fed. Well, they're selling now. Foreign central banks. Well, they're selling now. Big, large money, long dated, pension funds, real money type accounts. Well, they're stuffed to the gills with bonds. Like, who is going to buy the bonds? Like, that's the question. And the answer is, it's tough to find the person who's going to buy the bonds. And the way that gets resolved is just through a repricing,